Hi, and thanks for joining us. For those of you who are not familiar with me personally, I'm Sherry Burnham. I'm a certified financial planner in Madison, Alabama. Our local office is Investors Resource, which I'm president of, and I'm also branch manager for the Raymond James Financial Services Madison office branch. So thank you for each and every one of you clients and guests who are joining us today. We are very, very concerned about your investment accounts, and as I know that you are. And the purpose of our chat today is really to communicate with you on some structural changes within your investment portfolios, which we think are very, very crucial at this point in time. It is my strong opinion that the landscape of our financial system has changed, and that individuals really, really do need to take a look at how their investment portfolios need to adapt to these changes. I see no reason to just throw out every strategy known to man just because investments might be down at this point, but I do think that we really do need to be evaluating every single person. You know, why do I own a certain investment? Is this a good thing to own going forward? And just because you may have lost money in it, you know, what's the recovery plan? You know, should I be owning this going forward in the future? Is this going to, you know, help me in my recovery efforts? And again, if indeed the financial landscape has changed, then what are we doing about that? And do you agree with the philosophy going forward of your advisor's investment approach? And so thanks so much for joining us, because these are tough economic times, and I think it's high time that we communicate with you on a little bit deeper level our latest thoughts in that area. You can access some of our PowerPoint presentation materials directly from our website. That is at www.invresource.com. That's short for Investors Resource. It's right off the home page. Just click, 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 and you will have several of these PowerPoint materials there at your disposal. My comments today are really going to be reserved for our client accounts that are managed mostly on a discretionary basis, which means these accounts are just bought, sold, traded, moved automatically on your behalf. Versus us having to call you or something along those lines. And that is the majority of money that we do manage at this point. Comments also will be, in general, related to two key industries for which we actively manage your 401k accounts. We can't move them on your behalf, obviously, but we do actively call you and say move from X to Y and that sort of thing. So those are with the TVA, Tennessee Valley Authority, and with Intergraph here locally. Our portfolios, kind of how they stack up a little bit. We have two actively managed portfolios, an aggressive one and a moderate one, both targeting one an 80% stock position and a 60% in the other. Under most times our allocations are a little bit less at this point in time. Those are typically for a little bit more, for a larger account balance, because we're looking at holding, say, 10 to 15 things, you know, slices of the pie in those at any given time. We also operate core and satellite versions of those portfolios, which we are for, say, account sizes under 100,000 that we still want to maintain a little bit more active approach for, but due to size, you know, we can't slice and dice and it be really in the client's best interest for you just can't slice and dice smaller ones quite as much as you can the bigger ones, so it just doesn't make economic sense for our clientele. So those are going to be mostly what we're talking about today. And again, please consult the web for additional details on this. You know, pretty much the way that we've managed money in the past has really been dictated under two different tenets. First of all, diversification through asset allocation, meaning, we'd buy the large cap, the small cap, the international, the fixed income, and we would basically sort of find categories that we felt like were in favor and target spreading your money by asset classes that didn't correlate with one another, meaning when one zigged, another zagged, and the combination of those two things produced a little bit more consistent return overall. And we had a very detailed academic process for that. Again, the highlights are on our website. The other tenet that we've always maintained throughout my 20 years of doing business is we buy, we hold, and we tweak, which is a little bit more dynamic process than just buy, hold, and forget. It overweights or underweights either certain sectors of the market or certain categories of the market. In good times, we hold a little bit more of something, or if something has sort of fallen out of favor, we might eliminate that altogether or just have a lower weighting in that. That process, again, it's dictated on the web. It sort of involved basically, it was highly a mutual fund related type of approach because we love the diversity of that, and when internal expenses were very important in all of that, and are today. We relied and still do rely heavily on historical performance in the management team. We wanted, if we're going to pay those managers a % a year or whatever we were going to pay them, we wanted those managers to have established track records and to add value for the money that we were paying them. And in general, we wanted them to be good stock pickers. We didn't want to go and buy just an index, a basket of the index, because we wanted that manager to be superior, and deliver value for that which we were paying them. And in general, through this process, some of the managers that we relied on, just didn't perform quite to the degree that we wanted them to perform, and those managers have been eliminated at this point. So those that we're hanging on to, we feel very, very good and positive about. But that process, and you can take a look at the pie chart, the illustration of this was highly, buy, hold, tweak, and highly long-term, although we did do, I think, a very good job of harvesting some gains and that type of thing during this whole process. And the reason that we went to the trouble of developing this over the last 20 years is, and we subscribed to and still do to a certain degree this, long-term process, is that, if you got out of the market, if you were scared and if you missed the 30 best days of the market by cashing out, well, you ended up over a 20-year period losing half of your investment returns, and that's just kind of hard to fight. So we very much do subscribe to a long-term buy and hold philosophy, but perhaps a little less so in difficult economic times, because if you actually flip that statistic and you say, okay, well, what if I had missed the 30 worst days of the market? What would that do to my investment performance? Well, guess what? The statistic, holds true again. You would have significantly, bettered your performance had you have sort of taken the opposite approach and allowed for pieces of your portfolio to be out of the market during, the tougher times. So our approach is sort of morphing with the times, and the fact that we were out of the market for, a portion of that which that has just hit us has helped tremendously. Not to say that we didn't get hit along with everyone else, but it the tweaks have in general helped, and we are employing more of those going forward, and I'm really excited about this new approach, hence again us doing this webinar. If you will take a look at the slides on the website, and those of you who are watching live, there is a new revised approach, and we don't want to throw out the baby with the bathwater. As I say, we want to keep asset allocation as a piece of what we're doing, but we were adding to our diversification definition. In the first piece we've already implemented, and we've started implemented. We haven't fully gotten in 100% into our position, but we are adding a trading platform, which essentially is going to take advantage of price movements. It's sort of the buy low, sell high approach. And since you cannot, time the market consistently, and I don't feel like we can do that with 100% of our portfolio, but we can certainly use volatility to our advantage in a couple of different ways, and if we are flipping that statistic and being willing to be out of the market with pieces of our portfolio, during the nasty times, and if we're willing to put a hard sell limit on an investment to say, hey, once we've made X% on it, we're going to sell it regardless of if it keeps going up. We're going to sell it. We're going to lock in those gains. Then I believe that over time that is going to, again, make volatility our friend instead of our foe. The other piece, as you can see on our slides, that we are adding to our approach is an economic trends piece. We need to be able to, especially at in difficult times, and we don't even know what's ahead of us and really how to fully implement this piece within the portfolios, but that's a lot of what I'm studying at this point. Is we need to take advantage of broader, higher level trends. For instance, let's say the next shoe to drop is the banking system overseas. And I'm not saying that this is going to be the case, but let's just entertain this as a thought process so that you can better understand this economics trends piece. Our banking system here in the U.S. is, I feel like, pretty much on solid ground. I mean, the government's going to go and take care of rescuing most, any problem that might occur. At least that seems to be where the administration is going. I mean, we've when the money market rates breaking the buck happened, the government said, well, we'll FDIC insure that, and we'll raise FDIC limits on current banks, and we'll give banks additional capital. And so because the banks and the Fed, the Treasury, all these things are very interconnected, our system at this point, banking-wise, in my opinion, is fairly strong. But this is not necessarily the case overseas. The ECB is not interconnected, and if deleveraging is still happening at this point, then perhaps the next wave of issues that we might be dealing with globally, at least, is perhaps some bank failures overseas. And if that starts to be a trend, that's going to affect the dollar, and that's going to affect the euro and currencies. And so how can we best play that within our investment portfolios? Well, one way to do it is you could be participating in some type of a precious metals play, or you could long or short things, or there's just any number of strategies which could be implemented. In our discretionary only aggressive and moderate portfolios, we have implemented a index related precious metals play within those portfolios at this point, and on a small basis, and I would assume that we would continue to add to those types of things, even in our core and satellites and in our 401ks and the other things that we manage. But at this point, that is a key part of what I'm trying to get a handle on within our portfolios, because I think as we mature in the cycle of recovery, that piece is not going to be so dependent on whether the market's going up or down. It's going to be dependent on what's going on globally and how can we best respond. So it's a very key piece, in my opinion, of diversification going forward. So as you can see, with this new strategy, that really might change some of our, key tenants. You're probably going to see, you've already seen some product changes, moving away in general from mutual funds. Maybe we've implemented some exchange traded funds, ETFs. We've got greater control over buying and selling those trade during the day, just like a stock. If you retain some diversity of the mutual funds, and that's going to be key in our trading layer, is using some of those ETF positions. We are adding additional products that are probably yet to be determined for our economic trends piece that we sort of talked about, but really the objective at this point in my view is that we've got to give credence to a variety of investment theories when we talk about diversification and portfolio construction. You need something that's going to be long-term focused, because guess what? You can't fight that in every single 20-year period. If you just would have bought and held and not buy, hold, and forget, but buy, hold, tweak, that has in general worked over long periods of time if you've got a disciplined process for doing so. And we need to give credence to that. Volatility is probably going to be here for a while, and how can we best deal with that? And if being out of the market with a piece of our portfolios, because being out for the worst times also improves performance, we need to have a way to structure that and deal with it. And we also need to get away from just letting stock markets and equities, if profits are going to be harder to come by, and if consumers are not going to be able to spend as much going forward because unemployment and jobs and pressure and media and all of that, then we need something that's not correlated to the markets whatsoever. So alternative investments and macroeconomic trends do become a lot more important. So, I want to be able to take specific questions from you guys on this, and it may be a little too early to get a lot of questions, but it's just I want to communicate that this is going to